let's start with the news of the week. There's a question that I think everyone in this room is dying for me to ask you, and that is, did you watch the debates on Monday?
I watched the debates, and I made my way most of the way through a new bottle of bourbon. The bourbon almost offset the debate.
Well, you used to famously spar with Donald Trump on Twitter, or maybe, I don't know if sparring is the right word.
He never responded. Marc Cuban figured out how to get under his skin, so I'm going to let Marc do that.
Well, I was wondering if you have or plan to get involved in the election in, a more meaningful way.
I don't think so. I mean, we run a very kind of loose. We don't really have a policy on this at our firm, and so people do various things. And I've done things in the past, but I think probably not.
Okay, but it's safe to say you're voting for Hillary. That much you've made clear. Okay,
yeah.
Great.
Yeah.
Okay, there was another.
Was that a near miss? Did I almost just kicked off stage?
No, not at all. Okay, there was another big story this week. You said you were taking a Twitter break, and you appear to have deleted your many thousands of tweets. How many people have asked you this week why you are quitting Twitter?
About 400,000.
I believe it. You do have people freaked out. They're completely freaked out. Yeah. They don't know what to do on Twitter without you. I did want to ask,
I think they'll get by.
It's so funny, though. Really, you've upset a lot of people. I did want to ask if you've quit Twitter to drive down the value of Twitter for a possible Facebook acquisition. Marc, as everyone knows, is on the board of
I think Twitter will probably
Facebook.
do okay without me, too.
Well, I was going to say, this is maybe too much information, but this is sort of funny for me personally, because when I first met you, after starting STRICTLYVC, you very generously let me come down and spend an hour with you. And at that point, you had tweeted twice. Once to say twittering, and then 6 years and 18,000 followers later to say, have I missed anything? Yeah. I did want to ask, people are curious though, have you archived the tweets?
Oh, I've got them all. I've got everything. They're in the vault.
Oh, good.
They're literally in the vault.
Oh, yeah?
Yeah. Nobody's getting them if I don't hand them over.
But, you have used it with great success. You are, you've always intrigued people, but more than ever, since they had this sort of, daily picture of you. And you'd said once that reporters are obsessed with it. It's like a tube. I have loudspeakers. It's like a tube, and I have loudspeakers installed in every reporting cubicle around the world. So, do you see a day when you, embrace it just maybe less actively?
Oh, I'm gonna keep my options. Oh, I mean, in all honesty, I feel 50 pounds lighter.
It was just too many.
I feel free as a bird.
Yeah, I'm sure. Well, I'm sure it was like an obligation after a while.
Well, yeah, and just like it's just it's a hothouse environment, and it's great because it's a hothouse environment, and everybody's active and everybody's passionate and enthusiastic or angry, as the case might be, on different topics, and especially this year, it's the whole environment in the U.S. is just so politicized. It's the election year, right? So it's just so politicized, and so it's a little bit of a relief to just take a step back, let things pass for a little bit.
Yeah, you're just a little bit exhausted. Yeah. Okay, so let's talk for a few minutes broadly about the industry, and then I want to kind of get into the mechanics of Andreessen Horowitz. Early on, I remember first sitting down with you in 2009 when you and Ben had first started the fund, and you had talked at some length about the research that you were sort of centering your thesis around, which was Andy Ratcliffe's very early research. Andy Ratcliffe was a co-founder of Benchmark, and he had realized that every year there are 10 to 15 breakout companies that reach $100 million in annual revenue. And you said you've got to get into those companies, to be a top VC. Is that number bigger, smaller, the same today? It seemed so specific at the time, and I still,
Yeah, so Andy made this, and Andy's kind of our godfather and kind of taught us a lot of what we know about this stuff. He now teaches over at Stanford on this topic, and when he ran the numbers some years back, he said it's shocking. Basically, the consistency of the number of new companies per year that matter is shocking, and by matter I mean companies that reach a certain level of impact. Sort of escape velocity. And one proxy for mattering is revenue, and so the number that he used was 100 million in annual revenue. And historically, if a venture-backed company reaches 100 million in annual revenue, it does quite well and generates very good returns for the VCs. And so the thing that he thought was so striking was basically from like 1970 to 2010, that number was 15 a year in the US with very little variation. And what's counterintuitive about that are a couple things. One is it's sort of true. He found it to be true across cycles. And so it was true during the hot times and true during the slow times. And then the other thing that was striking about it was, the world is a much more complex place, and there's many more technologies now than there were 40, 50 years ago, and people are much more adapted to technology today than they were then. And so you would think that you'd have a much larger number of tech companies and a much larger number of tech companies. And he over that period, the data didn't support that. So I would say like there's a big question around this about what's happening today, and I think there's two theories, and I would say we argue this inside our firm all the time, and I argue this at night alone by myself with the rest of the bourbon, and I can argue both sides of it. So I can argue the side of it, the sort of call it the optimistic side that there will now be a larger number of successful, important new companies every year. And the reason for that, right, has to do with our thesis we call Software Eats the World. The reason for that has to do with the tech industry, the Valley, and venture capital are much more aggressive in this decade than they were before at creating and funding companies that aren't just tool companies, right, that don't just build computers and routers and servers and disk drives and so forth that you sell to businesses and consumers. A lot of the best new companies in the last 5 or 10 years are companies that directly enter incumbent markets in other industries. And there's many obvious examples: Airbnb in hospitality, Lyft and Uber in transportation. There's all the new fintech companies, and so forth across all these different categories. And I like to observe, like, Airbnb directly entered the hospitality industry, right? Directly gives you, a place to stay. 10 years ago, the predecessor to Airbnb was not a failed version of that, right? 10 years ago, the predecessor to Airbnb would have been a small boutique software company that sold booking software for small hotel chains, right? And we would have called that basically the way that tech helps make hospitality happen. And that would have been and there were companies like that, and they were successful, but they were just small because there are only so many boutique hotel chains, and they only buy so much software. Whereas Airbnb can get much larger because it can just enter the industry directly. And so that is encouraging or suggestive of an idea that we in tech and venture can create and build companies in many more industries than we used to be able to. The counter argument to that is that's just pure hubris. We are, recreating .com bubble 2.0 for real. We are going to, it's going to be a Shakespearean tragedy again, because this, all of our recent success has gone straight to our heads, and we're smoking our own supply. And this is just silliness, right? And an example of that would be, if you talk to people who run the big car companies, they'll tell you that they think Silicon Valley has just lost its mind, because there's now 7 major new aspiring car companies in Silicon Valley, right? There's, and you go right down the list. It's Apple, Google, Tesla, Uber, NextEV, Faraday, Zoox. Like our 7, I could just name off the tip of my tongue that are literally new Silicon Valley car companies. If you believe that cars are becoming, autonomous, self-driving, basically, rolling smartphones, where software makes the difference, then maybe Silicon Valley can take on the car industry. All the people who run the car companies think we're just completely out of our minds. One of the CEOs of one of the car companies, I'll try not to swear too much, but he's like, "You effing Silicon Valley effers, you just don't effing understand how effing hard it is to build an effing car," right? And historically that's right. Like, there hasn't been a major new car company in the U.S. since like 1925, right? And so this is the interesting thing, and I think you could make a good argument on both sides, and I think the answer to that question will determine a lot of the future of the Valley.
So you're not sure. Well, also,
we're making bets. I mean, we're behaving like we know.
Right. But also, these companies are happening all over the world.
Yes.
So I guess I'm wondering if the 10 or 15, because you're mostly focused on Silicon Valley. Yeah. So do you miss some of them if it's happening in China or India or elsewhere?
Yeah. So number one, for sure, yeah, we're missing. Like, by definition, we're missing everything in China because we're not investing in China. So, yeah, for sure. So there's two questions there. One is just what's the best way to practice VC, and we're just believers. We're believers that obviously VC can change and can be innovated on, and we've tried to do that. That said, we don't currently have a model for how we do VC in more than one location. So our model is still a boutique model. There are obviously people, including I'm sure in this room, who have a model that involves much more geographic expansion, and a lot of the top firms have done a lot of geographic expansion. And Sequoia, as an example, has a very successful China effort. We haven't figured out how to do that within our culture yet, and we might or might not at some point in the future. The other question, though, is like, okay, so what is the role of Silicon Valley more broadly in the global sort of technology and innovation business? And there, what you would say is it seems obvious, and I'm a believer, it seems obvious that the culture of startups, the culture of technology, the culture of entrepreneurship, innovation, and by the way, venture capital, is spreading worldwide. And you can now go be on the ground in probably 30 or 40 cities around the world and see a very interesting dynamic startup scene, including, by the way, a friend of mine has spent quite a bit of time in Tehran lately, with now the sanctions coming off, and he's been over there quite a bit. And there's actually, it turns out, a thriving high-tech, a new nascent but thriving high-tech entrepreneur scene in Tehran.
Wow.
And they're all fired up, and they can't wait for all the embargoes and trade restrictions to be fully lifted so they can expand their companies, throughout the rest of the world. So I think I am a believer that this is spreading, and this can go very broad. On the other hand, the data tells you a more difficult story, and the data says that venture capital specifically is actually concentrating more and more into Silicon Valley, right? And so the percentage of venture capital into the valley is rising, not falling. And that side of that argument would just be that the locality effects are so strong, right? If you're going to build the winning company in any given part of the tech industry, you want to be in the best place in the world to do it. The best place in the world to do it is the place that already has the critical mass of the most people and the most talent, right? To be able to have the best chance of success as a company. And a lot of people would say right now that's Silicon Valley. And so that again, I think is you have very different conclusions about the shape of the tech industry 20 years from now, depending on whether you think the valley stays as dominant as it still is.
Are you concerned that too much money is finding its way here? Interest rates are still not going up. Oops, I think Chinese investors want to invest their money here. Family offices want to invest more in startups. A lot of people are worried about how we're going to deploy all this, and I really don't see where it all goes. What's your sort of thinking about whether we can absorb all of this capital that wants to find its way here?
Yeah, so it goes back to that first topic of the change in the industry. So, and again, I'll argue both sides, which I do with myself again all the time. So one argument is just, actually Andy makes another observation that he taught us, which is basically venture capital, you could argue, has been overfunded effectively forever. It's actually been overfunded not just recently, but it's been overfunded going all the way back to the 60s and 70s. And his argument there is basically just that there's more demand, institutional investors who want to put money to work. There's just more demand to put money into tech and venture capital and to get the theoretical returns than there is supply of opportunities to do it. And that's just been he calls that sort of a semi-permanent state of affairs. And that has to do with how these large institutions manage their portfolios. And basically, in a nutshell, what the modern way that these large portfolios are managed is they have this kind of pyramid allocation model where they have lots of safe cash and bonds at the bottom, and then they kind of work their way up through riskier assets. And then at the very top of the pyramid, the model basically says have a 4% allocation of venture capital. And of course, a 4% allocation of venture capital, if you invest in the venture firms that back the winning companies, that makes total sense. All the institutions that can't get into the firms, if you can't get into the top, 10 or 20 firms, if you can't get into the great new firms, they still put the money to work, right? And by the way, they might put that money to work in other firms in the valley, or they might put that money to work outside the vallay. And in some cases, they end up putting it. It's always surprising. Like there's on the order, you probably know, 400 to 600 venture firms in the U.S.
I'm shocked. I would think it was a lot less at this point. I mean, there used to be what, like 1,200.
Yeah. When we entered, I remember in 2009 there were 800, and so one argument, right, is just the just too many got created in the 90s, and a lot of them are zombies or pulling back in some way. But still, if you travel, I mean, there are local venture firms in a lot of towns and cities in the U.S. where you'd be a little bit surprised, and I think that might be. I mean, and again, good news means you can fund startups in those places. Bad news, maybe not all those places are the best places to build companies. Maybe the returns won't quite follow. So I think that that is that's just a dynamic. Just money wants to come in, and to your point, now more money wants to come in, right? Because the world has slow growth, right? And so the world is in this sort of weird place. So just an example, a number. So people get freaked out because there's the amount of money coming into the valley. Private tech right now is about $50 billion a year, and people say that's more than before. And so how on earth can you possibly invest that? Well, there's $13 trillion of government bonds worldwide right now that are trading at negative yield. Right, so there's institutional investors, and by the way, people saving for their retirement have given governments in the form of government bonds $13 trillion of real money, and they have to pay for the privilege of loaning it to those governments, right? And by the way, That's actually not true in the U.S. Actually, the U.S. is still positive. Actually, oddly, some of the more distressed countries, for example, in Europe, that appear to have shaky national finances have these negative yields. And so something very weird is happening in the world economically, right? Interest rates are super low. And so what that says is just there's just much more money in the world that needs return than can possibly get it, which just means there's a massive shortage of productive places to put money. Which is not really a question of VC as much as a question of...
It's a drop in the ocean.
Of industry, yeah. VC is a drop in the ocean, and even $50 billion a year is a drop in the ocean. And so the way I look at it is, it goes back to that first question, if the total number of opportunities is fixed and small, then yes, the whole sector gets overfunded, and then you might legitimately get another bubble out of that at some point. On the other hand, if the number of opportunities is expanding, then we, broadly, the tech industry, may be the place where more people are going to be able to get returns, and then there might be more money coming in that can get productively deployed.
I wish you had more definitive answers, Marc.
Well, these are very big questions.
No, I know. I appreciate you trying to take them on. You know, another thing that I think people are wrestling with here, and you've talked about this at length, is, and I talked to Xander about this a little bit, you know, private versus public. Public, you've said, and I think a lot of people would agree, that, you know, things have changed. Now you have to answer to shareholders every quarter, or there's sort of like this drumbeat of expectations, versus privately held companies, which can invest in R&D and have much more freedom in how they operate. But, I mean, so what's happening? I mean, all these companies still have to go public. How do you ensure, I mean, how is it going to be any different for today's private companies when they go public? What's to sort of safeguard them from the same fate, I guess? Yeah,
so it is true. So it is true that it's much harder to be public today than it was 20 years ago when I started. It is true as a consequence that many private companies are going public much later. It is also true, this goes back to the 50 billion number, it is also true that therefore, right, one of the reasons why venture capital and private tech investing is up so much is because it's literally substituting for IPOs. And I think this is, for example, this is what I've always said about the unicorn phenomenon. The thing about the unicorn phenomenon is whether those companies, you know, take as an independent variable how many of those companies will succeed or fail. I think it's a fact that in, you know, 1996 or in 1984 or in 1968, all of those companies would have gone public by now, right? And they would either succeed or fail as public companies, but they all would have gone public. And so a lot of the late stage, and so I always tease like my friends, the newspapers love the headlines of like this you know, record-breaking huge number of venture capital, huge amount of venture capital. It's like, okay, well just take out Uber's last round, right? And it like cuts the number in half, right, for the year, right? It's just like, and you know, Uber's now been able to raise on the order, somebody might know, it's like $14 billion of private money. Right? Just never, there's no historical precedent for that at all. And so what's happened is you just have private money substituting for public money. Now, to your point, I do think, and we do think, that in the long run, at least as we understand the way the world works today, in the long run, most or all of these companies will and should go public at some point. It's just they're going to go public later, and the advantage of going public later is they're going to go public when they're better able to withstand the pressures of being public. But I think there's no question. We do see for most and maybe all of these companies, the ultimate fate is becoming a public company.
Speaking of Uber, Uber is an outlier, obviously, in many ways, including its funding situation. But Bill Gurley was recorded in a podcast with ReadCode recently, and I thought what he said was interesting. He said when Uber goes public, he was theorizing, but you know, it'll have to be profitable. And meanwhile, there are all these sort of heavily subsidized competitors around the world who will immediately undercut it on price and try to steal its market share. So I guess, you know, two questions. One, is this a concern for Lyft? And also, is it, you know, is it a danger for all companies that are going public? Because there are so many privately funded competitors, that seems like this is going to be sort of an issue for a lot of them.
So here's the thing is, so the cliche then, the cliche that kind of leads you to these conclusions in my view is the cliche is like once you go public, you're done, right? Once you go public, you can't innovate anymore. Once you go public, you can't bring cash anymore. Once you go public, you can't invest in the future anymore. And it's not that that's completely wrong. Like a lot of companies do go public and get trapped in this mode where they feel like they can't do that and they get on this kind of quarterly treadmill and the long-term goals go out the window. However, it is interesting to observe, right, that the entire Apple turnaround, right, happened as a public company, right, and happened as a public company with very long-term investments in R&D and very big ambitious plans, and happened entirely as a public company with Steve Jobs owning literally 1 share of stock, right, and so like the whole founder control thing, like 1 share of stock was what that guy had.
I didn't realize that actually.
Yeah, yeah. He had sold after he got fired from Apple famously in I think '84, and he literally sold all but 1 share of his stock because he wanted to get the prospectus every year because he just would get so mad when he would read it. And now you say, okay, Steve was able to do it. Steve was a special guy. Maybe that's not generally applicable.
And different time.
Well, although he did it all the way through. I mean, he did it through the boom of the. He came back in '97, so he did it through the great boom of the late '90s when a lot of big companies were losing all their talent to startups. He then did it in the first half of the 2000s when everybody hated everything involved in tech, including Apple. Nobody ever thought the turnaround would work, and then he was able to do it all the way up through the new boom when again a lot of big companies had a lot of talent pulled away. So. And it's been well documented how he did it, but the fact is he did it as a public company. So then you say, well, okay, well, what? Okay, is he the only one? Well, he's not the only one because Jeff Bezos is able to do it, right? And so Amazon Echo now is this giant home run hit. Jeff has said the order of magnitude of the effort of investment in Echo was 1,500 technical experts for 4 years, which is the kind of thing that you would think maybe you can't do as a public company. It turns out you can. By the way, he also did the Fire Phone, which was sort of a famous catastrophe, and everybody said, of course, that means Amazon will never succeed at anything involving hardware. And so he's got the holes in the ground, and he's got the moonshots that work. Marc Benioff, I think, is doing it now at Salesforce. I think Reed Hastings is doing it at Netflix. I think that there's a whole. I think Jensen Huang now at NVIDIA is doing like really amazing work, really amazing long-term R&D work that's now paying off in the form of all these all the AI chips that he's doing and powering VR. And so they do exist, like they do happen. And I think there's a pattern. I think it can be done. I think it just has to be done. It has to be done very thoughtfully. I think it's very irresponsible to take a company public and then immediately get trapped in the short-term treadmill and stop making long-term investments. But I think it's equally unacceptable to take a company public and just assume you can just tell Wall Street to pound sand and do whatever you want and like earnings don't matter. And so, but there are various ways in the middle to navigate through it, and many of the companies we respect the most are able to do it, and so I think it's a doable thing.
And obviously, the companies that you've mentioned, they're very much, the founders have a lot of control, which is key. So I know that you work with...
Although again, not necessarily formal control, right? So it's actually interesting. Steve didn't have formal control of Apple. Jeff never had formal control, voting control of Amazon.
Oh, he didn't?
No.
Oh, I didn't realize that. Okay.
Amazon was famous as a single class stock.
Okay.
And then, of course, historically, Bill Gates never had voting control of Microsoft. So there are, generally speaking, this phenomenon of voting control being the key.
So you'd say you don't necessarily advise your startups that they have to have like a dual class of shares, or how do you sort of?
Well, we generally do. We generally do because I think it makes it easier. And in particular, there was this whole activist thing over the last 5 years where there were a bunch of these big companies that had activists kind of attack. And the activists are pretty consistent. Most of them are pretty consistent in what they want, which is kill all long-term investment and just give us the cash back. And that is, that will be, when they do that, that is death for innovation. So it is useful. Now, I will say the activist movement does seem to be fading. It does appear that a lot of the activists have not been making money, and some of them have been they've got significant train wrecks on their hands, and so that threat is receding a bit. But even so, I would still encourage dual class stock, and I was, when Facebook did it, I was very happy, and so forth. I think, on the other hand, I think what Jeff Bezos demonstrates and what Steve demonstrated before him is it's not formal control that makes a difference. It's having a vision and a real vision and having a plan, right? And being able to be able to sell people on it, and be able to sell people inside the company on it, sell people outside the company on it, and really to be able to make clear. And if you listen to Jeff or read Amazon's annual letters, are really good on this because he just lays out in great detail. Here's what I'm doing. If you like it, invest. If you don't, don't. And he's got 20 years of track record that it's generally a good idea to just take him at his word and to invest and let him do what he does. And so you build up credibility over time. And so I think performance, well, so one of the things we say, like, there's this sort of thing in the Valley of sort of founder friendly is kind of the term. And we always kind of like to say, my old boss, Jim Barksdale, years ago said, this ain't a family and I ain't your daddy. And so founder friendly, like companies are not social clubs, right? It's not founder friendly and it's not founder control. The founder gets to do whatever they want and it doesn't matter. It's all based on performance, right? There's no tenure for founders. Professors get tenure, founders don't get tenure. And the reason is, even if you have founder control, if you screw up, if you are a bad CEO, if you have, dumb product ideas, if you are not, motivational, if you can't bring people with you, they all quit, right? And so you're sitting in the middle of your company cafeteria all by yourself saying, I'm in control. Like, it doesn't get you anywhere. And so I just think at the core of it, I think a lot of these issues are important, but I think they're a little bit around the edges, whereas the core issue is the very substantive issue of what is the company to do, what is the product to do, what are the leadership principles of the company, what's the culture of the company, what is it in the mission of the company that gets people to come with the leader, Like those things I just think matter a lot more than a lot of these mechanics. And I think if you have all that, I think you can succeed as a private company. I think you can succeed as a public company.
Right. Well, so special companies will get through. There's going to be a lot more M&A, as you mentioned at a recent Bloomberg conference. But I'm also wondering, and you mentioned there's going to be a lot more M&A by non-traditional investors, which we're seeing, GM buying Cruise, private equity firms like gobbling up SaaS companies. Why isn't Amazon making more acquisitions, or Google or Facebook?
Yeah.
What's going on?
So I think it's coming. So I think a lot of those companies. We see it. There's a very big wave of M&A forming up, and so there's been a gap, and you like the cynical view would be companies got overvalued, right? The just like
they're waiting.
People want to buy. There's a lot of companies that people in theory want to buy. They just got they got marked up too much. Falling prices are no fun, but they do tend to create options in the form of people start to be interested in buying. So part of it is to any extent, any price correction will generally result in more M&A. Also, a lot of public companies, including public tech companies, not as much Google and Amazon, but a lot of other public tech companies that were big buyers in the past came under a lot of this activist pressure. And so there was sort of a lot of the big historical public companies that bought startups. They either had activists in their stock or on their board. I mean, even Microsoft now has an activist investor on their board of directors, right? Which is an idea that would be unheard of 10 or 20 years ago. And so even like a company like Microsoft, which traditionally has very much been in control of its own destiny, to get an acquisition through, they have to convince the activist investor that it's a good idea, and that's a hard hurdle for some of these guys. So as the activist threats, and if you either had an activist involved, it was hard to do deals, or if you were operating under the threat of an activist becoming involved, you didn't want to do anything to trigger it. And so if you combine kind of high prices with activist movement, that balled things up for a while. I think also, I think that just time has passed. I think there are a fairly large number of big companies that now know that they're strategically exposed. Because technology has changed, and there are new things happening in the world, and in some cases they can innovate their way into it internally, but in the time-honored tradition, a lot of cases they buy things. And then the big thing is the non-traditional buyer is what the bankers call them, which is a new phenomenon, which is you didn't used to have Under Armour showing up in Silicon Valley and buying, I forget which company that I think it bought, MyFitnessPal.
Right.
You didn't used to have GM show up and buy Cruise. You didn't use there's been a wide range of these. I mean, about once a week, I'll open up TechCrunch and I'll be like, ooh, that was surprising, right? You would not have expected that. And we're now seeing it. We're seeing it in our pipeline. And then that again goes back to that original question, which is, if you believe, the way we describe it, software eats the world. If you believe tech is becoming more important in more industries, and if you believe that we can build companies in more industries, then it follows that our companies will end up being bought by incumbents in more industries. And again, that I think is a very positive view of kind of how big the valley can get and how big our industry can get.
Right. Okay. Great. So I think everyone in this room is very interested in Andreessen Horowitz very specifically, because you're just a very interesting firm. Okay. One observation that I know that you'll disagree with, but I think is sort of widely perceived to be true outside of Andreessen Horowitz, is that you're sort of responsible for the valuations that we've seen in recent years. You guys were not price sensitive. You were willing to pay up. Whether or not you agree, I mean, it feels to me, as somebody who's covered the industry for a long time, that you did come and change the game on the field. Do you agree with that, or do you disagree with that?
So this one has been frustrating for us because we don't believe it's true, but it's very helpful. And so we always go back and forth whether we want to talk people out of believing it, because founders love the idea of a VC that overpays. And so to the extent that that's helped us with deal flow, it's hard to argue with. We've maintained for a long time it's not true, and we have reams of data to support it, including the fact that we're not the top bidder on almost every deal we do. So we've always asserted it's not true.
Well, that might be true now, but weren't you for a while? It seemed like there was a window in time where you're like, let's get this thing going, and then you stopped.
So I think
and everybody else came in.
But people view that as action on our part. I view that as a reaction, a reaction to the environment. So our view very specifically was after the financial crisis. So it just so happened timing-wise that we raised our first fund in March of 2009. Which is just random coincidence. March of 2009 was the low of the stock market after the financial crisis, and we all lived through that. We're all young enough or old enough in here that we lived through that. I'm not always with people who are old enough to remember 2000, unfortunately, but everybody remembers 2008. So So the financial crisis, right, was catastrophic to the national economy, to the global economy. It was catastrophic to the credit markets. It was catastrophic to a lot of traditional industries. And everybody believed in 2008, 2009 that it was going to be catastrophic for tech, right? And that led to a lot of prognostications, and it was from a lot of people in the ecosystem, in the environment, which is like, you know, this is it all over again. It's all going down. I mean, we had founders of companies we were already involved in calling us up saying, like, is this, you know, is it over? Like, are we ever going to be able to raise money again? Is the Valley going to just close up shop again? And so things got very dark. And so our view was that was a fundamentally illogical proposition. And the reason that was an illogical proposition, that it was going to be, you know, so actually Game of Thrones kind of ruined everybody's ability to think logically about this stuff, because the tagline is "Winter is coming." And so ever since Game of Thrones came on TV, like, every headline now is "Winter is coming." It just never quite gets here. So, so our view was the financial crisis, that the 2000 crash, which was catastrophic to tech, was an equity crash, right? It was an equity bubble and an equity crash. The 2008 crisis was a debt bubble and a debt crash. Of the companies in the economy that are the most exposed to equity, it's tech. And so we took the brunt of the 2000 crash. Of the companies that are least exposed to debt, tech is least exposed to debt. Our companies don't run on debt because we can't get loans from anybody, right? It's not actually even through choice. It's because how do you underwrite a loan to a company that might not be around in 2 years? And so our companies in the Valley generally have very little debt. And so there was it wasn't like, unlike the banks, right? The banks were least exposed to equity. They're most exposed to debt. They didn't take much damage in 2000. They took tons of damage in 2008. And so tech was just on the right side of what was happening. And so we thought that, number one, that the damage wasn't nearly going to be as bad as people thought. And then, we observed, here comes the smartphone, right? The iPhone had just come out. Here comes mobile broadband, and we saw Google growing, and we saw Facebook growing, and we saw these things happening, and we said, this is actually a good time. And so we thought things were cheap. And I think I think it's now become clear in retrospect things were cheap.
Right. Okay, another thing that you hear all the time, but I have to ask you, is it's hard to be a top-performing fund at your size. I think there's a lot of academic research to suggest that, smaller funds have higher returns. It seems that if you are in the top companies and you can invest in them across multiple stages, that sort of counters that effect. But Andreessen Horowitz is not an investor in Uber, which seems to be sort of the defining company of this last decade. How does that impact you?
Oh, so I mean, we're in a spectacular set of companies that are doing extremely well. So I'm not going to second guess any individual investment decision, because if you do that in this industry, you drive yourself bananas.
And you're obviously not the only one who turned it away.
So I'll pass on that specific comment. Okay. What I will say is I'll go back to the broader category of this private-public, this difference in private-public. And so what's happened is venture capital, our assessment, so back to first principles, our assessment was the entire nature of the industry is that the winners generate the vast majority of the profits, right? And so and whether that number is 10 or 15 a year or 20 or 30 or 40, out of 2,000 or 3,000 or 4,000, tech just has this power law curve where if you get one of these companies, you get a Google, you get a Facebook, one of these companies, they generate disproportionate profits for the entire industry. They carry the entire valley economically because they pay for everything else. And so, including all the companies yet to be formed. And so there is this characteristic where this kind of massive payoff at the top of the power law. And then there is this very interesting opportunity that had opened up around the same time that we started, which is the fact that companies didn't want to go public or couldn't go public meant that private capital is going to be more important. And so we've leaned straight into that. Our view on growth investing, when we do growth investing, our view is we're still venture investing. And so when we invest, the way that private growth investing used to work is you'd invest in what were called mezzanine rounds, which are usually characterized as the last round before the IPO. And so you get an investor to come in and give you your last round of money before you went public. You go public 6 months later, and you kind of model it so that investor would get a 30% return. And those investments still happen, and companies still raise those rounds. We don't do that. We never do that. We never underwrite an investment to that. For us to make a growth investment, we always have to believe that the company, it may or may not work, but if it works, it has 5x, 10x, or more opportunity. A great example, I mean, it's easy to cherry pick from the past, but Peter Thiel kind of articulates this really well. He famously put the first $500,000 into Facebook, which was one of the great all-time seed investments. And he's been investing, for 20 years. And he said the single biggest investing mistake that he's made was not investing in the Facebook Series A, right? Which was the Excel round, which was at 90 million pre, which, by the way, everybody in the Valley knew was horribly overvalued and doomed to failure. He said the second biggest mistake that he made was not doing the Facebook Series B, right? At 500 pre, which was done by Greylock, which everybody also knew was a terrible idea and doomed to failure. And so for the really spectacular companies, there are these multiple entrance points. And so we leave ourselves open strategically to be able to do those.
Okay. So there's, to your point about, your growth investments, forgive me, but the New Yorker had also, sort of a VC, a rival, obviously, had talked to Tad Friend and had sort of done some math that you didn't seem to like. Updating the math a little bit, this person noted that to make 5x to 10x across your 5 funds, which have now raised $6.2 billion, sorry.
Something like that.
Some humongous amount. The aggregate market cap of your portfolio would need to be in the hundreds of billions of dollars. Or, I guess, put more simply for this English major, you need, what, like 30 billion in returns?
Yeah.
That seems really daunting.
We're elephant hunting.
Yeah.
Like, we're going for it.
Yeah. Okay. Well, one of your biggest bets, and your most sort of promising bets, is Airbnb.
Right.
Have you invested in more than one round there?
No comment. I mean, we're primarily in one round.
Okay, so you're in another round that nobody knows about.
If it's not public, I'm not going to say it. But,
okay.
Yeah.
Well, this is just this came up at some other event that I had attended, and I thought it was really interesting. Alfred Lee of Sequoia Capital. So Sequoia also passed on Uber, but Alfred had written a check to Uber personally, and he was saying that he thought Airbnb's valuation was never going to quite reach Uber's because people are sort of just never going to be as comfortable renting out a home in their house as they are putting their car in the service of Uber, which I just thought was interesting. What's your thought on that?
Honestly, we don't really sit around and have those conversations.
Okay.
It's not a I mean, for us, it's not a comparative, on a day-by-day basis, it's not a comparative game. It's more a question, we're with Airbnb, we're completely focused on Airbnb. And I mean, as you know, they're just a spectacular success, and I think they have huge growth ahead of them. Okay. So we don't really index that way.
Okay. Yeah. Well, in terms of elephant hunting, 3 exits, IPOs, M&A, private restructurings, how do you feel about secondary sales? Do you use them?
Specifically private secondary.
Yeah.
Private secondary.
Yeah.
Yes. So it's an interesting phenomenon. So I've seen private secondaries go very well, and I've seen them go very badly. The very well scenario is basically, and maybe very logical to think about, is just if a company's going to stay private for longer, then it's going to get to be 6, 7, 8, 9, 10 years old. There are going to be employees who have been at the company, for a long time. At some point, when you're young and living on ramen noodles and, afford an apartment, it's fun to kind of skate by. With stock options, you get married, you start to have kids, you start to come home, your spouse is like, what the hell are you doing? We need to buy a house, or at least we need to rent our own apartment. We're not going to live with another family. And so you do get this there's just kind of just natural demographic generational thing that happens inside companies, and it's a legitimately good idea at some point for there to be some release valve. If you're not going to go public in the near future, it makes sense to have some kind of release valve. There's a related thing, which is sometimes it's actually a good idea for founders. There is the old philosophy was that the founder is lashed to the ship like an old sea captain, and like the founder doesn't get paid until the company gets sold or goes public, and like if the company is worth a lot and then becomes worth nothing as a private company, like the founder gets nothing. And the old VCs will tell you like that's what you had to do because it's so hard to build these companies that you have to have that kind of attitude. The downside of that attitude, I think in some cases were founders who felt like they had to sell their companies early because they had obligations that they had to meet, for example, their families. And so I think there are companies that maybe could have gone on to be much more successful that sold quickly. And I think a little founder liquidity in some cases actually can help with a long-term mentality. So those can work. When those programs work, they're orchestrated very carefully. They generally are very carefully controlled by the company. The company thinks through in a great amount of detail where the stock should end up in the hands of investors that understand what the company is doing, that the transactions be done in a way where everybody's treated fairly, that the transactions happen for maybe employees who've been there for 4+ years, but not for somebody who's been there for 6 months. And so those mechanisms can work, and we have helped people do those. We've participated in those. Those can work. I've also seen it go badly wrong, where companies basically go public without being public, and where there's just an orgy of random, uncontrolled secondary sales into all kinds of hands. There have actually been prosecutions. There are these bucket shops. It's like literally Wolf of Wall Street kind of bucket shops that specialize in remarketing opaque secondary sales of private companies. And some of you may get these emails because they blast out these emails. And the emails will literally have fictional made-up financial projections. Right? It's just outright fraud. And they take the stock from these companies and they market it to places where it should never go. And then you've seen other places where employees who've only been there a short period of time are able to sell a lot of stock and quit, and the culture of the company collapses. And this goes back to, it's like the founder control thing. It's like the founders, there was a point in time when the founders said, I want total control. We should have total control to sell our private stock whenever we want. The new generation of private founders are much more focused on this has to actually be a controlled process. I actually think at some point, like, I'll give you sort of the dark side view of this. There are active SEC investigations on this topic for companies when it has gone out of control, and it may not even be the companies. It may or may not be the companies that are at fault. In some cases, the companies might, arguably in some cases, be at fault. In other cases, there's just fraudulent transactions happening. What are going to look after the fact, like fraudulent transactions between employees and random buyers, in the dentists and doctors in the Midwest. And I think the SEC is going to start stringing people up here pretty soon. And Mary Jo White has been talking about this.
Facebook seemed to have this problem. I mean, anecdotally, was there any?
You're not giving a lot of detail on that. I think that I would just observe that it's striking the degree to which many of the best new companies are much more tightly controlled on this than Facebook.
Right. Well, that's good to know. I wasn't sure what your stance was. So then, obviously, IPOs. You've had some of those. You've had some M&A.
Just had an IPO last week. Yes.
Which one?
Aptio.
Oh, Aptio. Oh, congratulations.
Yeah, thank you.
So when you have an IPO, what's the firm's philosophy in terms of getting out of the stock?
Yeah. So this is interesting. So our LPs are very clear with us, which is they're paying us to manage private money and not public money. And so they tell us, basically they give us one marching order, which is give us the damn stock. Because now that it's liquid, we can make our own decision whether to hold or not. I would say it varies by company, and it also, by the way, varies on the preference of the management team. You get actually into these. You get into some circumstances where the CEO actually wants you to sell more stock because they want to increase the float. Because when the float of these companies is too small, the stock can whip around in a way that's very destabilizing. You have other companies where the companies are going through tough times and where the CEOs really do not want you to distribute because they want to keep the stock in friendly hands. And then you've got cases where you think the company has still venture-like return profile from here, and then you've got other cases where you're like, okay, at some point the product cycle is going to peak, and it's as a fiduciary, it's a good thing to do to at some point give the money back. And so you kind of it's an ad hoc. You kind of work it through kind of for each company.
Okay. So another thing that's very interesting about your firm is the agency style setup that you have. You have 130 employees, roughly?
135.
Okay. And I've heard you talk about how it helps each of you scale, which is interesting. But I have also heard from entrepreneurs that they are sometimes a little bit dissatisfied. They love all the services, but you join their board or you invest in them, or Ben does, or Chris, or anybody, and they discover that they have less access to that VC than maybe they hoped. I think this is part of the strategy, but the idea is
not part of the strategy. Yes.
Well, what will happen is they get referred to like a non-investing partner, and then maybe that non-investing partner refers them to a more junior staffer. Yeah. So I just wondered if that's anything that you've heard, or if that's something a concern.
Yeah, so the promise is very clear, which is it's an and, not an or. So the promise is that you get your GP exactly like you get from any other top firm, and then the promise is in addition you get the engine. Okay. And so anybody who says that, give them my cell phone number. Okay. And have them call the hotline, me, because we will fix that, because that should not be happening. So that's the theory. The positive side of it, what we're trying to do, Jeff Wu, who's the founder of NutriBox, one of our companies, he had the best verbalization of this. He said, getting investment from us, he said, is like plugging into the matrix. And what he meant by that is that we have in our firm, it's up to 85 now operating professionals across 6 teams, and it spans, basically the way I think about it is, it spans Fortune 500, corporate development, which is investors and M&A, marketing and PR, and then technical talent, executive talent, and now policy and regulatory. And so we've got 6 teams, 85 professionals, and what those folks do is basically build and run what is now, I think, the world's best network of access to all of these ecosystems and all these important people and all these important companies and entities in all these different areas. And these networks, we basically build and run these networks, and these networks now are large and very robust and very dynamic. I'll just give an example. As an example, we do 2,000 briefings a year with Fortune 500 companies, executives from Fortune 500 companies, including in a lot of cases CEOs, and these days actually entire boards of directors. We'll come in and we'll take, or the entire executive team, and we'll take them through, and we'll broker introductions to all of our portfolio companies. And so for people who kind of, when we're doing our job right, they get the GP, but they also get access to this level of access basically to the world, and this level of access to all of the people and all the connectivity they need to build a company that the goal is to basically fast forward them, several years into when they would have all that access themselves and kind of be able to skip over the part when nobody knows where they are. And I think in the cases where it works extremely well.
Well, I was going to ask, some of my reporter friends were like, you got to ask him about that Wall Street Journal article, which sort of questioned your returns or compared them to, frankly, much longer ago established firms. I'm not going to do that, but because you're not old enough to, you don't have the cash on cash returns yet, so who knows. But how do you judge yourself in the meantime?
I was going to say, I have a great answer.
Oh, okay, sorry, I'll stop talking then. No, I'm just wondering, how do you know that this network is having the intended effect?
Yeah. So this goes to kind of a core philosophy of how I think you do things that have the characteristic of unpredictable outcomes. So there's a lot of professions, a lot of businesses in the world where you can directly evaluate yourself based on outcome, right? I'm a recruiter, did I close that candidate? I'm a sales rep, did I get that deal? I'm a reporter, did I get that story, right? And it's sort of very deterministic, like if I do a good job, it works. If I don't, it doesn't work most of the time. Venture is one of those things, the sports metaphor is baseball. Venture is one of those things where, the best venture capitalists in the world still strike out much of the time. And it's just, we could talk about why, but it's just the nature of the beast, the unpredictability of the future and the amount of time it takes to know whether it's working. I'll give you an example. Like, I don't think, my understanding from, I've spent a lot of time with, VCs, been in the business for decades. My understanding is there's no VC I've yet met believes that they can stack rank the future returns within their existing portfolio. In other words, they can't pick out of their existing portfolio companies, they can't pick out which of them will be the most valuable or even any level of distribution within them. And they observe you get this routine thing where the one that comes out like a Roman candle at first often disappoints, and then you get these sleeper hits that end up being these giant returners that didn't look like they go anywhere. And so to your point, it takes 10 plus years to actually know, right? And then, by the way, it makes sense. The great companies take 10 plus years to build, and it's a lot of work along the way, and a lot of things can go right and a lot of things can go wrong. So the way we think about it, and we borrowed this from a lot of people who have come before us, is you basically have to separate process and outcome. If you evaluate, if you're not going to know the results over the next 10 years, you by definition you'll drive yourself crazy trying to judge outcome because you don't know. And if you try to find out, you're wrong. And so it just literally doesn't work. But at the same time, that doesn't mean you can just be nihilistic and just then say, okay, it's all going to be chaos and we can just be irresponsible because, like nothing matters. And so what you do, in our view, is then you concentrate on process. And so you figure out the core things in the business that really matter from a process standpoint. You engineer the best process you can to get the best results, and you evaluate yourself in that process. For example, the way we measure ourselves of how we're doing competitively on the process side is we do a competitive analysis every month, and we track all of the seed, Series A, Series B, Series C rounds done by all of the firms and individual investors we respect the most. And it's a list of 20 firms and individuals kind of combined. It's kind of a proxy for the high quality deal flow in the Valley. And then we have the number we track is the percentage of the investments that they made that we saw and had an opportunity to invest in before that company made its decision of who to take money from, right? And that number for us kind of ranges sort of goes back and forth between like 60 and 70%. And then from a process standpoint, what we're trying to do is we're trying to push that to 100%, right? And so the goal is we would like to see every deal that those firms and people do, and we would like to at least have had the chance to make the investment even if we didn't pull the trigger. Now, that still leaves a very important independent variable at play, which is, are we smart enough to pull the trigger on the right ones, right, and not dumb enough to pull the trigger on the wrong ones? But at least from a process standpoint, we will guarantee that we see the opportunities, and historically that's been a good predictor in the field.
How do you decide when to pull the plug? Sequoia has sort of famously very, intolerant about, well, not intolerant, but they've got their metrics, and if you don't meet them, curtains for you. So what about you? What about Andreessen?
So we don't. So the pull the plug is an interesting thing. We don't pull the plug. What happens is when they don't, they run out of money. And so in other words, it's not generally an active decision that says it's time to shut something down from us. It's more the founder has made a set of decisions that involve basically, for whatever reason, the company is literally, like in the worst case, ended up running out of money. I mean, we do everything we can to actually prevent that literal outcome, but it does happen from time to time. So the decision is not it's not an act of commission to shut a company down on our part. It becomes an act of omission, which is there's no more money coming from us. Right, and you get into these situations. You get into situations, companies get in trouble spots, and you get in situations where they can't raise outside money, which is kind of the kinds of situations we're talking about. And then they come in and they want more inside money. And by the way, venture capitalists broadly, I think, are pretty generous towards founders at providing. There are a lot of inside rounds. There are a lot of bridges. And part of the compact between the entrepreneur and the investor is if the entrepreneur wants to keep going, as an investor, you do try to support them up to some point. But again, going back to process, it would be unhealthy for entrepreneurs to have a continuous drip feed of capital no matter what, right? And by the way, at some point, even if the entrepreneur wants to keep going, at some point, all the people are going to quit anyway. And so at some point, the company's going to naturally unwind. And then, by the way, at some point, the founder would be better off doing something else anyway. There are these weird conversations you have where, because this gets so emotional, and we so much respect the founders. We especially respect the founders who don't want to give up. And so in the worst case, you get a founder who's like, it hasn't worked, and I still want to keep going. And you're just like, it's not going to work. You can just tell it's not going to work. Everybody's going to quit.
Time for radical candor.
It's time for radical candor. And you're just like, it's time. And it's time. And it's like, and you basically say it's time. It's time for you. And it's time for you literally to liberate yourself from this situation and get yourself to a better spot. And you do get, I will be honest, you get some cases 5 years later where they're still pissed, right? And so like you do get that, but you do get cases where they come back a year or two later and they're like, oh, thank God. In fact, actually, sometimes they have visible relief in the meeting, right? Where they're just like, oh, thank God I don't have to do this anymore. Like I don't have to be up at 4 a.m. anymore stressing out about this. And so I think this is part of the it's part of the partnership. When you think about like the term partnership, we take really seriously, like it has serious meaning, and we're a partnership amongst ourselves, but we partner with our founders, and part of that partnership is not just we'll support you no matter what. It goes back to what we talked about earlier. It's performance matters, results matter. At some point it has to work. And so there is a point at which there's no more money.
I think we're almost out of time, and I don't want to keep you. Can I ask a couple? Oh, last question. Okay, I'm asking you one more question. I guess that is, congratulations on being a father. I'm just wondering, how's it going?
Thank you. Fantastic.
How different is it than you expected? I sort of feel like.
Well, so I sit at work and I get all these pitches on AI, and then I go home and I watch the little guy. And the HI is still way more impressive than the AI. It is so fascinating to watch. And I'm sure every parent in the world has gone through this, but watching the process of learning and watching the process of growing and figuring things out is just absolutely, it's the most remarkable thing ever. It's amazing.
That's great. I can just imagine you having these conversations with him. On the one hand, on the other hand.
Right now, he's having those conversations with me.
Marc, thank you so much for coming. I really appreciate all your time.
Thank you, Connie.
Thank you,
everybody.
Thank you so much.